Hello everyone, and I hope you're all doing fabulously well, and another interesting week ahead in financial markets. Unfortunately, we couldn't start without saying our deep concerns and hope for peace in the Middle East. Sadly, and with deep sorrow, it does look though as if peace will not be easy to find. There will be no quick solution, and this is of course troubling for all of us, so we can only wish the best possible outcome of well-being for everyone involved at the moment. In terms of financial markets, we've seen stocks get marked lower, we've seen gold and oil get marked higher. I actually see that oil was ready in any case to make a lasting low where it was, and this will have been a catalyst for that. So oil will not have bottomed because of these unfortunate events, but oil will have bottomed simply for continuing high demand around the world and the lack of investment that has occurred in that industry over recent years due to the focus on renewables and geopolitical events beyond the scope of the more immediate, most recent events. So overall, that race for energy security will only be intensifying because of the situation in Russia, in Europe, and because of the situation, geopolitical tensions with China. It is good to see that there may be a discussion, a direct discussion between President Biden and China's President Xi Jinping on the sidelines of a summit in San Francisco this week. That would be wonderful, but we will wait with bated breath on that. Clearly, again, no quick resolution of geopolitical tensions can be seen in many parts of the world, and that includes geopolitical tensions in Africa at the moment as well, surrounding energy supplies for Europe out of some of those African regions too. So, oil higher. I do think also that the big trade could be that the United States is going to have to pay more and more for its ridiculous levels of debt. It's unbelievable. I mean, the US is adding enormous debt on a daily basis now. Its monthly deficit numbers are just completely shocking. The US is in a diabolical, plummeting fiscal situation, which cannot go on forever, which the greenbacks, supported by the US government having to pay more to fund those deficits, means lower bond markets, means prices, which means higher yields, which makes the US dollar attractive to some degree, but it becomes we are now moving into the realms of, is it enough to keep the greenback buoyant? And I would suggest to you that it isn't. Whether that is going to occur, that US dollar top is going to occur in coming days, this week, definitely a possibility in the next 2 weeks, or whether it's 2 months from now, difficult to say, but it is time to begin to focus on the possibility that US bond yields will be screaming higher, US bond prices collapsing in the not too distant future, even from these low levels, and the greenback beginning to decline as well, as various entities around the world are going to see, well, really the luster come off the allure of holding US bonds. They will begin to look less and less secure going forward. That means ever higher yields, bad for the US economy, and eventually a significant break in confidence. We've already seen plenty of cracks, and we'd all have our heads in the sand if we didn't know there were problems with the USA, but a real crack in confidence, which could see the greenback tumbling rather significantly over the next 1, 3, 4, 5, 6, 7, even 8 years. We could be close to the commencement of a fresh multi-year downtrend for the US dollar of some 10 to 20%, even 25%. We know that the value of the greenback has been reduced 40 45% simply through inflation since the turn of the century, and it's going to come under increasing pressure in its real valuation vis-a-vis other currencies. And of course, the currencies to compare it with are very much the BRICS currencies. The euro has its own difficulties. The Australian dollar can have its own difficulties in a slowing global economy and markets, though the Australian dollar will be buoyant from these higher gold prices. So I'm seeing the risk of a greenback sell-off. At the moment, I'm long US dollars. But if I start to see this scenario, big picture scenario play out, I will obviously change that. So I'm not saying this is something that's going to happen today. I'm long US dollars today. I'm short Aussie. I'm short euro. I'm short bonds too, US bonds as well, and I'm short equities. But I'm thinking people need to start to consider at what point are higher yields simply not going to be good enough to invest in the extra risk of this fiscal diabolical situation that the United States now finds itself in, which just continues to deteriorate on a daily rate at a record pace. It's absolutely stunning how bad the fiscal position is and how money is just pouring out of taxpayers into government expenditures on a daily basis. It makes it very difficult to see how that economy can hold up going forward. We did see some stability in the non-farm payrolls on Friday, nice little bounce in those, may not be sustained, but again, those little chinks of signs of stability in the US economy, which we've already seen a little bit of in manufacturing, but all of this is perhaps a stability, and we also saw pressure come off in wages a little bit. Wages growth was more reasonable at 0.2%. So signs of some stability to the US economy, but this will be a weakened US economy that finds some stability. So not a reason to be buying stocks. I remain bearish equities. I'm long the dollar, as I said, and just one more reiteration of that. I do think you need to be watching in case the US dollar begins to plummet. And if it does, oil shoots through the roof, and so too does gold. So here's a big forecast for gold. Within 2 years, gold could easily be trading at $2,500 US an ounce. That would be on the back of a weakening US dollar trend and on the back of continuing strong industrial and jewelry demand, as well as, of course, the allure of gold as an alternative safe haven should the greenback lose that status. I hope that helps. Have a great week ahead. Clifford Bennett.